We continue to believe that we are in a super cycle of alternatives. And while, given the macroeconomic challenges we are facing this year, especially with rising interest rates, inflation, and the geopolitical tension, are dampening fundraising this year for the first time really over the last 2 decades. We strongly believe that we are in a long-term structural growth cycle for alternatives, but a lot of investors still under-allocated, especially the non-institutional capital.
That's interesting. So I think you acknowledge some of the challenges and there will be perhaps a lower flow rate. What do you think the collapse of the SPAC industry means for private equity? Because the SPACs emerged as a challenger for buying some of the assets that I think private equity may have looked at. Does it make any difference, do you think, to the opportunity for private equity and the kind of return rates that it can make going forward?
I think you're absolutely right. While SPAC has been a challenger, and there obviously a lot of capital flowed into SPACs last year, and now is being redeemed out of it, we do still think the opportunity set for private equity is vast out there. And that is across the spectrum for private equity, starting with the growth all the way to the large buyouts. So while that is not one of the asset classes we predict to grow the fastest over the next 6 years, which we think will be venture capital and private debt and infrastructure, private equity is still expected to show very solid AUM growth and very solid risk-adjusted returns, as it has over the last 2 decades.
Christoph, really good to see you, and I find your report absolutely fascinating as well. So let me just go over that headline again that Jeff mentioned. AUM from private capital to double to 18.3 trillion by 2027, VC to grow to over 4 trillion. That is a vast amount of money in the private sector that doesn't need the stock market, that when it comes to the stock market is going to come with a different level of valuation as well. And we know that because there's more money that's available privately, it means perhaps fruity valuations publicly as well. What does it mean for the stock market that so much vast amounts of money is going to be gravitating privately rather than on stock markets?
I think it's a trend that we have seen emerge over the last few years, with companies just staying private for much longer than they have in the past. Back in the early 2000s, it was a couple of years. Now it can be decades. And in the case of Preqin, we are still a privately held company, and we were founded 2 decades ago. So we strongly believe that private companies will stay private for longer, which means that a lot of the value creation that is happening before they hit the stock market. And we strongly believe that private capital is key here in driving that innovation to eventually have some of them list, but probably not all of them, because the capital is available.
Yeah, look, there was a very well-received book this year by Sebastian Mallaby called The Power Law, which I've read a great chunk of. I must admit I haven't finished the whole thing, but it's basically talking about the failure rate amongst VC and just making viewers or readers understand that there is a large failure rate, but the ones that make it, the unicorns that really make or become unicorns, or home runs as they call it, they have to be quite stratospheric. So there is going to be a vast amount of money sloshing around in VC world that's just going to fail. So a huge failure rate, and I think our viewers need to know that as well, don't they?
That's absolutely right. I think people should be aware there are obviously certain risks with investing in private capital, and venture capital is very much one of those industries where there are a lot of bets being placed, smaller bets, that lead to failures, but then also to outsized returns with some of those investments. Just thinking of some of the technology giants today, they started as early stage VC investments.
So what does, this report plus the repricing of money, what does that mean? Because the repricing of money has meant that there's actually very interesting. I know that if you've been a long-term gilt or bund or treasury investor, you've had an absolutely horrendous 2022 in terms of the value of your underlying asset. But your gilt yields now, your treasury yields, they're all quite exciting. So the repricing of money, what's that done to this?
What we're seeing is that the investors are still very interested in alternatives as a way of diversification. And that hasn't changed, irrespective of the repricing that we are seeing today. So while some of the fixed income instruments might see higher yields today, so will private assets and private debt, for instance, with some instruments linked to that environment will offer that protection that investors are looking for.
Yeah, I mean, the interesting thing is I think valuations are going down as well, aren't they? I mean, so in fact, even as maybe less money comes in, particularly to mid-market private equity businesses, the amount they're going to have to pay for assets is also declining, I think, as owners have to kind of reset expectations.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.